Hello, my name is Dr. Ulbrich and I'm pleased to show you a new strategy which is called Fear and Greed. And the mechanism of the Fear and Greed strategy is that the strategy buys a pullback in the trend, or if the trend has gone too far, it does the same in the opposite. So it trades on a daily bar, and as always, you can see here the blue dotted lines are winning trades, and the red dotted lines, like this here, are losing trades. The strategy trades a maximum of two contracts, and it trades the two contracts via the pyramiding, or it's pyramiding via these position limit settings of TradeStation. As the strategy trades on daily bars and has no trailing stop or things like this, you don't need to use the look inside bar backtesting, because the strategy will not change if you turn it on or off. And the strategy has 6 inputs and a stop loss, but the stop loss is not very important here on the strategy and will not change much. If we look into the performance of the strategy, we can see that it has a good performance over a long time. You can see here the performance is from 1997 to 2013. And what I did, I optimized the middle part here of the strategy, and so the force and backs times is auto sample. And if we look for, and the strategy basically trades a lot of stocks and basically all the indices. And if we look into the results, we see that on the E-mini, the average trade net profit is $327. There's no slippage included, but the slippage on the E-mini is quite low. So if you take $10, I think you're already on the safe side. And as the strategy buys pullbacks, it's important to see with which drawdowns we have to calculate. And for example, if I look to the weekly underwater equity curve, I see that the maximum drawdown appeared here is 20% in 2001. The E-mini is approximately $5 on each point, so it's 5 times 1,500, which is approximately $75,000. So it's a $75,000 contract, and if you lose 20% on a $75,000 contract, it's approximately 15,000. But in the last years, the losses were smaller. For example, here in 2011, we had a loss of approximately 5%. If we take 5% out of the $75,000 contracts, it's approximately $3,500. So $3,500 should not kill us. Here, when we look at the maximum adverse excursion, we see the single trades. And you can see here that the losses on a single trade is in the maximum loss is approximately $4,000 to $5,000, but more between $2,000 and $4,000. And on the winning side, we see that the trade gains are clustered here. A lot of gains are small, $1,000, $2,000, and some bigger ones. And I did, to explain it, I did several optimization settings. And here, for example, I've chosen optimization setting which goes in on small gaps down. And you can see the how the strategy works here. Because if there is a dip down, it buys one contract. If the dip goes further down, it buys a second contract and hopes that it will regain. And in most of the cases, it regains. Here, for example, you can see 2 losers. And in this setting, the strategy holds trades only for a short time. As most of the big indices move in tandem, it's important for us to have a diversification. And I will give you an example, because here I optimized the E-mini, and here I optimized the FDAX. And as you can see, they moved approximately more or less in the same manner. But the E-mini had a little bit more drawdown here. And the FDAX is optimized in a different way, because the FDAX is optimized in a way that it takes bigger drawdowns and hold the trades for a longer time. You can see it here. It's approximately from August to early October. It's maybe 1.5 months, this trade here, and of course it was a big winner. And if we look into the strategy performance report of the FDAX, we see that it has winners from 20,000, from between $10,000 and $20,000, but also losers from $8,000. And I did the different optimizations between these two to not be in the market always at the same time. And if we look into the winners and losers, we see here winners and losers are equally distributed, and here we have much more winners than losers. And you can play with the parameters, and here the day parameters to set the gap are big. And if you choose bigger numbers here or higher numbers here, you buy deeper gaps, and if you choose small numbers, you buy in smaller dips. So here's this quite small number. And we go through. Here, for example, is the big Standard & Poor. And the benefit on the big contract is, of course, that you have more history, but you need to trade it different. Here, for example, is the mini Dow future, which is quite good. Even if we look into the weekly underwater, we see it's approximately 6%, which is quite good for a day trading strategy, for a strategy trading on daily bars. And the average day net profit is around $1,000, quite good too. Here on the S&P 400, we see a quite good performance too. Then the Russell 2000. The Russell 2000 makes 112,000 with an average trade net profit of 446. Here the E-mini Nasdaq, $493, which is quite good because it's a small contract. Here we have the Eurostoxx 50. And the Eurostoxx 50 is a small contract, and for such a small contract, the average trade net profit of $444 is quite a good one. And if we look into the underwater, we see 10%. It's okay, because the contract is not so big. You will probably be able to survive it. And here on the FDAX, and the FDAX, of course, is a quite heavy contract. And we see that so it's quite a good build-up. And here the average net profit is $2,153, and total profit is $430,000. You will be able to bring these strategies together in a way that they build a portfolio, and you will be able to optimize it in a way that if you test it, you will find a positive development for 10 years, 20 years, or how much history you ever have. So yeah, and I recommend that you check out the equities, because on the equities the strategy behaves also very good and you have a lot of opportunities. So I wish you success in trading. Bye bye.